Hello dear students, myself CMA Padmaja Buzruk. I will discuss accounts of joint stock companies. Please go to study note number 1, accounting of shares and debentures. I will discuss issue and redemption of preference shares. Repayment of preference capital to preference shareholders is known as redemption of preference shares. First we'll see issue of preference shares. As per provisions of articles, company can issue redeemable preference shares. That means issue of redeemable preference shares is as per the provisions which are given in articles of association of company. At the time of issue of preference shares, manner of redemption of these shares is disclosed in prospectus. Manner of redemption means whether shareholders will be paid by cash or whether these shares will get converted into equity shares at the time of redemption. That will be disclosed in prospectus at the time of issue of preference shares. The terms of issue generally stipulate the time of redemption and whether the redemption will be at par or at premium. Redemption at par means preference shareholders will get back face value of shares. If preference shareholders are entitled to get back amount more than face value or above face value, then it means redemption is at premium. Shareholders will receive amount which is more than face value of shares. Irredeemable preference shares are those preference shares which cannot be redeemed except in the event of company being wound up. That means when shareholders get back their capital only on winding up or closure of the company, these shares are known as irredeemable preference shares. Issue and redemption of preference shares, section 55. There are various subsections. One by one we'll see these subsections. Subsection 1. No company limited by shares shall, after the commencement of this act, issue any preference shares which are irredeemable. In short, it means company limited by shares can issue only redeemable preference shares as per Companies Act 2030. Now we'll see subsection 2. A company limited by shares, if so authorized by articles, issue preference shares which are liable to be redeemed within a period not exceeding 20 years from the date of their issue, subject to such conditions as may be prescribed, provided that a company may issue preference shares for a period exceeding 20 years for infrastructure projects, subject to redemption of such percentage of shares as may be prescribed on an annual basis at the option of such preferential shareholders. So I will explain you what is given in this subsection 2. In short, as per subsection 2, these shares are issued for a maximum period of 20 years from the date of their issue, subject to prescribed conditions. And for infrastructure projects, these shares can be issued for a period exceeding 20 years. And certain percentage of these shares are redeemable annually at the option of shareholders as per prescribed manner. Continuation of subsection 2 of section 55. There are various clauses. We'll go through these clauses. Clause A. Further provided that out of profits of the company or out of proceeds of fresh issue of shares made for the purpose of such redemption. That means redemption can be either out of profits of the company or out of fresh issue of shares which are issued for the purpose of redemption. Clause B, redeemed of fully paid shares only. That means shares to be redeemed should be fully paid. Clause C, if redeemed out of profits of the company, then a sum equal to nominal value of shares to be redeemed transferred to capital redemption reserve account. So as per clause C, if redemption is out of profit, then sum equal to or amount equal to nominal value, that is face value of shares, is to be transferred to capital redemption reserve account. It is known as CRR in short. And there is one more clause, we'll see that, clause D. There are various subclauses of these clause D. We'll see these subclauses. Subclause 1. In case of class of companies on which provision of section 133 is applied. Section 133 is about central government to prescribe accounting standards. So in case of companies to which section 133 is applicable, the premium, if any, payable on redemption shall be provided for out of profits of the company before shares are redeemed. So if shares are redeemable at premium, then premium on redemption should be provided for out of profits before shares are redeemed. If premium is payable on redemption of any preference shares issued on or before commencement of this Act by any such company shall be provided for out of profits of the company or out of company's securities premium account before such shares are redeemed. So again it is same. In case of redemption of preference shares at premium, then premium is to be provided for either out of profit of the company or securities premium account. Subclause 2. In case not falling under subclause 1, if the premium is payable on redemption shall be provided for out of profits of the company or out of company's securities premium account before such shares are redeemed. So in short, as per subclause 1 and 2, premium on redemption of preference shares should be provided before shares are redeemed, and this is to be provided either out of securities premium or out of profits of the company. Now we'll see section 3, subsection 3 of section 55. As per subsection 3, it is not possible, if it is not possible for company to redeem any preference shares as per the terms on which these shares are issued or pay dividend on these shares, then these shares are known as unredeemed preference shares. So we'll just go through this. Subsection 3 of section 55, where a company is not in a position to redeem any preference shares or to pay dividend if any on such shares in accordance with terms of issue. Such shares hereinafter referred to as unredeemed preference shares. It may, with the consent of the holders of 3/4 in value of such preference shares and with the approval of tribunal on petition made by it in this behalf, issue further redeemable preference shares equal to the amount due, including the dividend thereon in respect of unredeemed preference shares, and on the issue of such further redeemable preference shares, the unredeemed preference shares shall be deemed to have been redeemed. So I will explain you what is given in this. With the consent of shareholders holding 3/4 in value of such shares, that is unredeemed preference shares, and with the approval of tribunal, further redeemable preference shares are issued of the value which is equal to unredeemed preference shares, including dividend. On this issue, unredeemed preference shares shall be deemed to have been redeemed, provided that the tribunal shall, while giving approval under this subsection, order the redemption forthwith of preference shares held by such person who have not consented to the issue of further redeemable preference shares. If any of the shareholder does not give consent to issue of further shares, then tribunal orders redemption of these shares. That is what is in short. Subsection 4 of section 55. The capital redemption reserve account may be applied by company for issue of fully paid bonus shares to be issued to the members of the company. So, bonus shares, fully paid bonus shares can be issued out of capital redemption reserve account. Issue and redemption of preference shares by company in infrastructural projects. A company engaged in setting up and dealing with infrastructural projects may issue preference shares for a period exceeding 20 years but not exceeding 30 years, subject to the redemption of a minimum 10% of such preference shares per year from the 21st year onwards or earlier on proportionate basis at the option of preference shareholders. So in case of companies which are engaged in infrastructural projects, these companies can issue preference shares for a period exceeding 20 years, but this period should not exceed 30 years. And there is one condition. Redemption of minimum 10% of preference shares per year from the 21st years onwards, or it can be before 21st years also on proportionate basis, of course at the option of preference shareholders. Now we'll see capital redemption reserve account. Amount transferred to capital redemption reserve account is from profit, and from which profit it is allowed, that we'll see now. That is profit otherwise available for dividend. So transfer to CRR is only from free reserves, and these are general reserve, reserve fund, dividend equalization fund, insurance fund, workman's compensation fund, workman's accident fund, voluntary debenture redemption account, voluntary debenture sinking fund, and profit and loss account. Transfer to CRR, capital redemption reserve account, is not allowed from following profits because these are not available for dividend distribution to shareholders. These are securities premium account, forfeited shares account, profit prior to incorporation, capital reserve, and development rebate reserve. All these profits are capital in nature, so transfer to CRR from this is not allowed. Now we'll see accounting entries necessary for redemption and issue of bonus shares. Redemption of preference shares. When redemption is due and if it is at premium, redeemable preference share capital account debit, premium on redemption account debit to redeemable preference shareholders account. If it is redemption is at par, then redeemable preference share capital account debit to redeemable preference shareholders account. Sale of investment, if any, for fund, profit loss on sale transferred to profit and loss account. Sometimes for the purpose of redemption, if company needs funds, money, it sells investment. And if there is any profit or loss on sale of investment, it is to be transferred to profit and loss account. Entry for this is bank account debit to investment to profit and loss account. If there is profit on sale of investment, profit and loss account is to be credited. Supposing if fresh shares are issued for the purpose of fund, that is for the purpose of required amount for redemption, and if this fresh issue is at par, then entry is bank account debit to equity share capital account. If fresh issue of shares is at premium, then entry is bank account debit to equity share capital account to securities premium account. Transfer of premium on redemption. At the time of redemption, if redemption is at premium, then the entry is, we have already seen the entry, redeemable preference share capital account debit, premium on redemption account debit. This premium on redemption account, either it can be from securities premium or out of profits of the company. So that entry we'll see now. Securities premium account debit, profit and loss account debit to premium on redemption account. And payment to shareholders, redeemable preference shareholders account debit to bank. Nominal value of shares redeemed not by fresh issue of shares. That means if shares are redeemed out of profit and not by fresh issue of shares, then in that case nominal value of shares to be redeemed get transferred to capital redemption reserve account out of profit. Entry for this is general reserve account debit, profit and loss account debit to capital redemption reserve account. If bonus shares are issued, then entry is capital redemption reserve account debit, securities premium account debit to bonus to shareholders, and converting this to equity shares, bonus to shareholders to equity share capital account to securities premium account if at premium. Conversion of redeemable preference shares into other shares. Sometimes if redemption is not by paying cash to shareholders, but if shares get converted into other shares, then entry is redeemable preference share capital account debit to preference share capital account or equity share capital account. In this video, we have seen issue and redemption of preference shares, journal entries for redemption of preference shares. Thank you.